Apollo, thank you so much for joining us today.
Thanks for the invitation to be here, and thanks to everybody who's taken the time today to attend.
Yes, and I know I'm really interested to hear more about your water polo career, but we'll have to talk about that another time because I know today we're talking about some more pressing concerns.
Right.
So to start us off, can you speak about the COVID-19 outbreak and the implications it has for investors?
Yeah, no, and it is certainly the big question, the top of mind, and I think there are multiple implications for investors that I see with respect to COVID-19 and what's been happening over the past few weeks, and the first implication is actually not related to necessarily the market itself, but something that we have seen over and over in the investment world, which is that when you think about investing, there is the absolute analytical side and the rational side of investing. What we do see is there's also a behavioral side to investing. And what we've seen over the past few weeks is that the behavioral part of investing has resurfaced after years of just being there, but not really sneaking up its head. And what I mean by that, we ended up the financial crisis back in 09. And for the past 11 years or so, we have had a pretty remarkable market run. And what's remarkable about the last 11 years is how unremarkable it's been. In other words, what we've seen is that the market has been steadily going up and up and up in a pretty steady fashion. And in fact, when you look relative to the historical average, what you see is that the past 11 years up until December, they have been unusually quiet. And what it means to me is that investors have gotten used to a type of a market that is just unrealistic because it has been unusually quiet. And what it meant is that people were not only happy to look at their statements and see that they've made money, but also very comfortable buying into the market. And that's been the case up until a few weeks ago. When COVID came around, the big change that I've seen is that not only that the market took a big dip, but from an emotional perspective, people not only became unhappy to look at their statements because they're dropping, but something that is part of our human condition has settled back in, which is that we are wired to pay attention to things that put us in danger. One of my favorite sayings that life wins every day, death only has to win once. And what it basically means to me is that we are much more wired to pay attention to things that get us in danger and trigger a human emotion of fear. And that is what I've seen for the past few weeks is that, when the markets start dipping, we had that fear and uncertainty that accompanied the market drop. And the way it manifested is people, not everybody, but I did see in quite a few people in quite a few events, at least the temptation to think that maybe I should flee and sell. And fleeing is fine. It saved our life. If there was an animal chasing us, you run and that saves your life. But to me, what I've seen is that at least towards the beginning of the crisis, there has been that idea that maybe this is not a right time to be invested. And the reason I'm bringing this up is because the rational side of investing says that you should buy low and sell high. That's the most basic of investment statements. And when you think of the emotional side, it's quite the opposite. You tend to buy when things go up, and you try to sell when things are low. So we have to be aware that there's a behavioral side that's not always leading us as investors to the path of success. And in fact, it could be the opposite. And I'm not here to tell you that emotions are bad. Not at all. It's totally okay. It's totally fine to feel the way you feel because that's what makes all of us human. I'm just making everybody aware that quite often when you're thinking about making an investment decision, you have to ask, is that driven by a lot of rational thought or is it driven by emotions? And I think that's where financial symmetry and Alice and the team come in, because what a good advisor is trying to do is pay attention to emotions and at the same time disentangle them from investment decisions. In other words, pay attention to emotions, but don't make investment decisions that are clouded with emotion. That was towards the first part of the COVID, when the markets are really going down. We had that bumpy ride. And then all of a sudden we hit about a month and a half ago, we hit the bottom. And that was a really big moment of fear, and volatility was high in the market. And ever since then, we've been on this upswing in the market. And what I'm seeing is that investors are still concerned about what's going on, but is a different type of concern. And the concern is that perhaps we're just, the market just hasn't really paid attention because there's so much bad news going on in the economy, and yet somehow the market staged this rally, and there's a big disconnect between, you know, Main Street and Wall Street, between the stock market and what's going on in the economy. And that disconnect at some point will come due, and then maybe the market will tank again, which kind of goes back to this idea of is this more emotional or is rational? So it's this cycle of emotions that's up and down and up and down that I've seen resurface over the past few weeks. And we can talk more about the disconnect between market and the economy, but that's kind of what I'm seeing now, is that people are, from an investment perspective, they are curious about why is it the market has rebounded so much when there, 33 million people are unemployed and the economy shut down. So to me, that's what I've seen is these cycles. When it started with really a lot of panic, then things look bright. The market's been going up and up and up for a few weeks. But once again, there's a concern, a lingering concern of why is the market going up? And then maybe some people once again thinking that that there's something dark coming around the corner.